we are entering the next phase in our economic cycle, which means defaults are coming. At least that's according to Apollo Management, who in the latest credit market outlook highlighted that the default cycle has started. For those of you that don't know, Apollo Management is a private equity firm with just over $500 billion in assets under management, and one of the places they specialize in investing is in credit, meaning debt. The reason why this is so important is because in their most recent Outlook report, the theme of this entire report was that this default cycle has now begun and we're going to be seeing more defaults in the near future. And the biggest reason for this is, not surprisingly, the higher interest rates. Take a look. The report says with the Federal Reserve Bank keeping interest rates higher for longer, higher debt costs will weigh on company earnings and lead to higher refinancing costs. That's why in this default cycle, bankruptcy filings will rise and default rates will continue to rise in the coming quarters, especially hurting middle market companies. Now, I've already gone through and analyzed the report and I'm going to break it down for you here, but if you want to read the report for yourself, I will also link it for you down in the description. Now, just to make sure that we're on the same page, a default means that you go out and you take on debt. Maybe you go finance a new Gucci wardrobe. Now, you have all this new stuff and you have the debt that you got to pay for the stuff, but then you lose the ability to pay the debt. Maybe your income falls, maybe something happens to your job. You no longer have the ability to pay your debt. This leads to higher defaults. Now, Apollo Management talks about two different types of defaults. They talk about personal defaults and then they talk about corporate defaults. Personal defaults are you going out and financing something for your life and then you lose the ability to pay that. A corporate default is a business buying something for their industry, for their company, and then they struggle to pay off that debt. So let me start by talking about the personal defaults because that's a little bit quicker. This chart right here shows the default rates for credit card and auto loans for consumers moving higher. The green line are auto loan defaults and the blue line are credit card defaults. And what you can see is that currently the default rates are lower than where we were during the 2008 peak, but you can see the trend that default rates for credit cards and auto loans have begun to rise. Now, the reason why we're seeing a rise in consumer defaults is pretty straightforward. Number one, you have higher interest rates, which means your auto loan interest rates are rising, along with the credit card interest rates are rising. On top of that, you also have the higher cost of living because of all the inflation that we've been seeing, not to mention that now student loans have also begun. So people just have a higher cost of living. And now you couple that with higher interest rates, and that makes it more difficult for people to keep paying off their loans. This is where what Apollo Management is saying is that if interest rates stay higher for longer, which is what they predict, that means that we would continue to see an uptick in credit card defaults and auto loan defaults, which would hurt the general economy because if people don't have the ability to pay off their debts, well, then means banks are not getting paid and that hurts other parts of the economy. So that's what's going on the consumer side with default risks rising because of the higher interest rates. But now let's go into more of the meat of this outlook, which are the corporate defaults. Because if you start to see more businesses start to fold because they don't have the ability to pay off their debts, that could have another domino effect in the economy. So let's talk about that. Let's start by just taking a look at what's been going on with bankruptcies. This chart shows bankruptcy filings from 2018 until very recently. And what you can see is that over the years of 2020 to 2022, we had very low bankruptcy filings happen. Now, part of the reason for that has to do with the lower interest rates. So businesses were able to refinance their debt very inexpensively. But then you have this gray dotted line showing when the Federal Reserve Bank started hiking interest rates. And as you can see, as the Federal Reserve Bank raised interest rates over the last 18 months, along with that, bankruptcy filings also pushed higher. Now, we've been covering all of this in Market Briefs, which, by the way, is my free financial newsletter, where every day my team is working to break down what's happening in things like the economy, the housing market, the stock market, the global economy, and crypto. It's a free newsletter that you can read in 5 minutes or less every morning. So if you want to stay up to date on what's happening in the general economy, Market Briefs is a free and simple way for you to do that. So if you want to get Market Briefs, I got the link for you to join down in the description below, or you can go to briefs.co/market to start getting your Market Briefs for free. But the reason why this is important to understand is because there was this big growth of what are called zombie companies. A zombie company is a company that generates $1, but then has $1.20 in expenses. And so they're making less money than what they're spending. But these zombie companies have been able to stay afloat for a long time because debt has been so cheap. So investors were pouring money into them, banks were pouring money into them because they're hoping that eventually they'd be able to grow their incomes, grow their profits to exceed their expenses. But as interest rates go higher, that means debt costs go higher. That means banks need to make smarter investments. That means investors need to make smarter investments because when your borrowing cost is more expensive, you need to get a better return on your money to justify that investment. So as interest rates started to go up, that meant the money flowing into these types of companies that are losing money started to go down. And now if you're a company that's not making money, that's actually bleeding cash, and you can no longer get the outside money, you can no longer get the debt, you can no longer get the investment money, that makes it much more difficult for you to continue your operations because you're spending $2 or $1.20 for every dollar that you earn. And that's one of the reasons why we started to see this uptick in bankruptcies because, well, money just became a lot more difficult to get a hold of. But the question is, what will continue to happen if interest rates stay higher for longer? Well, take a look. This is a chart essentially showing the number of distressed loans out there. And what you can see is, again, after March 2022, which is when the Federal Reserve Bank started raising interest rates, the amount of distressed loans out there, meaning companies struggling to pay their debts off, has been rising and has risen quite a bit since 2021. So this creates almost like a two-pronged effect in the corporate debt market, because now if you're a corporation that's not making a lot of money or you're not making enough money to support yourself, well, getting more money becomes more difficult when interest rates are higher, which is one of the reasons why bankruptcy rates have risen. But then the second impact of this has to do with distressed loans, because now if you're a corporation and you have debt already, well, this debt is not a 30-year mortgage because corporations have adjustable rate mortgages, which means every few years, every 3 to 5 years, your debt readjusts. And now if your debt is getting ready to readjust when interest rates are a whole lot higher, that means your payments are also going to be a whole lot higher. And if you cannot support the higher payments, well, then that could put you in a difficult situation because, well, that means you're not going to be able to have the money to pay off your banker. So that creates kind of like a double-edged sword, a double punch in the corporate debt market. But it's not just corporations, it's also the commercial real estate market. Take a look. This is a chart showing commercial real estate loans held by different people. And what you can see that ever since 2007, the amount of commercial real estate loans has been growing. And we've been seeing banks extend more and more money to commercial real estate. Now, generally, that's not a bad thing because if banks are lending money to you to go out and invest in real estate and you're making money, you're going to be paying back the bank. There's no problems with that. But ever since the pandemic, we've been seeing a very clear shakeup in the commercial real estate market because some companies have gone hybrid, some companies have gone remote, some companies have downsized how much office they need. So still today, you have a lot of offices that are sitting half vacant. Now, a lot of companies are returning back to the office, but not with the same demands as they had before, and not necessarily with the same office requirements that they had before, which means now, if interest rates stay higher for longer, that means this commercial real estate debt is also going to be coming for refinancing in the next year or two, or that's when we're going to start seeing that wave because commercial real estate debt, like corporate debt, is not a 30-year fixed rate mortgage. That's many times a 5-year adjustable rate mortgage. So now, in the coming 12 to 24 months, as we start to see more of this commercial real estate debt come due for readjusting, if you are an office landlord and your building is not producing much revenue, but then your costs rise, not just because of inflation, but because your debt servicing costs are higher because interest rates are higher, that means now you're not making enough revenue as it is, but now your expenses go up, which could lead to more default issues according to Apollo management. So now we've seen what's going on with consumer loans. We've seen what's going on with corporate loans. Now let's talk about what's going on in the broader economy in the United States, according to Apollo management, which is also contributing to some of these changes in the economy and debt market. And let me start by talking about what the Federal Reserve Bank is doing, because during the pandemic, the Federal Reserve Bank was doing something called quantitative easing, essentially printing money, creating more money. That's what quantitative easing is. And the way that they did this quantitative easing was by going out and just injecting money into the economy. And the technical way that they did that was by going out and buying things like treasury bonds. Treasury bonds are loans issued by the United States government. So if the United States government goes out and they want to spend $1 trillion on whatever they want to do, somebody has to give the United States government that money. They can get that money from taxes, but the United States government is already not making enough tax dollars as it is. That's why we are drowning in this national debt. So if they want to go out and spend an additional $1 trillion, they can go out and raise the taxes, but the taxes are not enough. Then they could go out and try to borrow this money from places like China and Japan and other foreign countries, but there's only so much money that other countries will want to lend to the United States. Then they can try to have investors here in the United States lend money to the government. They can have banks and institutions lend money here to the government, but that might also not be enough to raise that $1 trillion. So then they also have the Federal Reserve Bank, who is a central bank in the United States, who has the ability to print money. Now, when the Federal Reserve Bank prints money, they can give this money to the government through this treasury loan. That means they're not actually just handing it to the government. They're lending this money to the government because the Federal Reserve Bank is buying treasuries, meaning the Federal Reserve Bank is lending money to the United States government. So now the government gets money by the Federal Reserve Bank. The Federal Reserve Bank printed this money out of thin air, and now the government owes this money back to the Federal Reserve Bank plus interest. This is what quantitative easing is, where the Federal Reserve Bank is continuing to print money and injecting money into our economic system. But what's going on today is not quantitative easing, it's quantitative tightening. And the reason why is because all this money printing by the Federal Reserve Bank created the inflation problems that we've been seeing. And now in order to combat the inflation, the Federal Reserve Bank is doing two things. Number one, they're raising interest rates. And number two, they're doing quantitative tightening. Take a look. This is a chart showing what the Federal Reserve Bank is doing, whether they're doing quantitative easing or quantitative tightening. Essentially, if you see that green line above zero, that means they're doing quantitative easing. More money is being created and injected into the economy. That means they're expanding their balance sheet. That's the technical term for that. When it's below zero, like what we're seeing now, that means they're doing quantitative tightening. They're reducing the balance sheet, meaning they're trying to pull money out of the economy, and they're not trying to create as much money as they were before. In fact, they're trying to reduce the amount of money out there. Now, the reason why Apollo Management is highlighting this is because if we're starting to see less money in the economy because the Federal Reserve Bank is reducing their balance sheet, they're trying to shrink the amount of dollars in circulation to fight inflation, that can make borrowing a little bit more difficult, because if there's less dollars out there, it could be more difficult for corporations to go out and find more dollars. In fact, take a look at this. This is a chart again by Apollo Management titled Bank Lending Likely to Shrink in the Coming Quarters. And what this chart is showing you essentially is that we're entering an environment with tighter credit conditions, meaning it'll be more difficult for people and corporations to go out and borrow money because credit is tighter. There's less dollars out there. And then you have the cherry on top, the third part of this puzzle, which I'll tell you in just a second. So this means now the Federal Reserve Bank is working to reduce the amount of dollars out there. Banks are entering this tighter credit condition environment where they don't want to lend money as much. And so now you have a lot of corporations with debt that's coming due. You're starting to see more loan kind of risks out there. But then you have the third issue, which is there isn't as much good debt out there as there was before, according to Apollo Management. Take a look. This chart shows the Fitch rated AAA and AA non-financial companies. And what you'll see is that between the early 2000s and now, the number of AAA and AA non-financial companies has fallen significantly over the last number of decades. Now, what this means is you have some agencies like Fitch. Fitch is one of the three major credit rating agencies that goes out and they rate debt. They rate credit. And this then gives a indication to investors as to how investment worthy an investment is. And a AAA rating is one of the top highest ratings. So when they're going out and they're rating these different types of debts, what they're looking for is how likely you're going to be paid back as an investor. So if you want to go out and invest your money into these debt investments, you want to know what your risk is. If you're going to have lower risk, you're going to expect lower returns. If you have higher risk, higher potential returns. And so what this chart was showing us is essentially the AAA and AA debts, these investments, these higher grade investments have been falling over the last number of decades, which poses some risks to investors or different types of opportunity for investors. So now that we understand all the things that are happening, let's talk about what this means, according to Apollo Management. Their theme and their thesis is that they want to look for lending opportunities, investment opportunities, where they can lend their money into firms with low leverage and high interest credit ratios. Essentially, they want to look for investment opportunities where they can get high returns and low risk. And to help justify this, one of the things that they're saying is that because of the higher interest rates, you can actually get more positive returns by lending your money out than before. Take a look. This is a chart showing the amount of negative yielding debt in the world. And what you'll see is that ever since the early 2022s, when the Federal Reserve Bank started raising interest rates, the amount of negative yielding debt in the world has fallen significantly. What that means is if you were to go out and lend money and get, let's just say, a 2% return while inflation was 7%, that means you're getting a negative 5% yield. Because although you're getting 2% interest, inflation is 7%, so you're actually losing value. But now, because of the higher interest rates, what Apollo Management is saying is that it is easier for you to get a positive return by lending your money, because the interest rate that you can get now through some of these lending investments are higher than what inflation is, so you can get a positive return. Now, at this point, you're probably wondering, well, what types of investments do you want to look for? And one of the things that Apollo Management talks about is they like to look for companies that have high equity and low amounts of debt relative to that equity. Take a look. This is a chart showing the debt to equity ratio for corporate America. And what you can see is that today in the 2020s, we are seeing a lower debt to equity ratio than really ever before. And this is where they say creates opportunity. Now, a low debt to equity ratio essentially means that a company has a low amount of debt relative to the value or equity in the company that they have. And so what Apollo Management says that they're looking for is that they want to look for strong companies that have relatively low amounts of debt with the ability to pay out higher interest rates because they want a safer investment with the higher returns. But they're looking for companies that have high equity relative to the amount of debt out there. Now, what does this mean for you? Do you want to blindly follow what anybody else does? No. You want to be a financially educated investor. This is where it's important for you to understand different types of investing. Like you can invest in companies. What Apollo Management is talking about is investing in the debt, because instead of just investing in the company, you can also buy bonds in a company, meaning you're lending money to the company. And so there are different kind of ways that you can invest your money. And what Apollo Management is essentially saying is now with this higher interest rate environment, that creates more lending investment opportunities. Now, of course, this is going to depend on what the Federal Reserve Bank is going to do for 2024, because if they start cutting interest rates super aggressively, then you can expect interest rates to also fall. But if they keep interest rates higher for longer, then that creates more debt investment opportunities. Again, this is why it's important for you to be a financially educated investor, to understand the different opportunities out there, to understand different perceptions and different ways of investing. That way you can make the best decisions for you, your family, and of course, your community as well. And if you want to stay up to date on what's happening, again, we have market briefs as a free resource, and I got that for you down in the description. So let me start by talking about point number one, which is that our economy isn't as strong as you might think, starting by reading you the first line of this report. The new regime of greater macro and market volatility has resulted in greater uncertainty and dispersion of returns. Now, when Blackrock is talking about this new regime, the thing that they're talking about are number one, the